This is a podcast from the Business Times.
The major US indexes closed higher overnight, with the tech-heavy Nasdaq leading the gains after NVIDIA's latest earnings reinforced optimism around the AI boom. But investors are now turning their attention to Federal Reserve Chair Kevin Warsh, who is due to speak at Jackson Hole today, amid a stubborn inflation and bond yields remaining at elevated levels. And here in Asia, inflation has also been making headlines this week. Australia and Singapore have both reported hotter than expected inflation, while Tokyo's latest data print point to persistent price pressures. The Philippines and South Korea have also responded by raising interest rates this week. So, what does this all mean for Asia's economies, markets, and interest rates? I'm joined today by an expert who will help us make sense of it all. Welcome to Market Focus Weekly by the Business Times. I'm Nicole Teo, standing in for Howie Lim. It's Friday, 28th of August, 2026, and I'm joined by Derrick, Asia Economist at Morgan Stanley. Thank you for joining us today, Derrick.
Thanks a lot, Nicole, for having me. It's a pleasure to be here.
Let's zoom into one of the most anticipated events this week. Fed Chair Kevin Warsh is expected to speak at Jackson Hole today. What is your outlook for bond yields from here, particularly across Asia? And what are the biggest factors at play that will shape the trajectory of these yields?
So as it comes to the rates outlook for Asia, there are two factors that we're keeping track of. One is obviously the Federal Reserve policy outlook. The second factor that we're actually very focused on is actually on the growth outcomes in Asia. Firstly, on the Fed, we have actually been of the view that the Fed doesn't hike this year, but we do note that after the recent inflation revisions, it does bring the year-end inflation forecast closer to where members of the FOMC had previously suggested that they would be in favor of a rate hike. So while we still retain our call that the Fed does not hike this year, it is a much closer call than before, as what our US economics team is highlighting. So if the Fed does hike against our base case expectations, it can be a source of upside risk to our policy rate forecast. The other factor, and arguably more important from my perspective, is the growth outcomes or the growth outlook. The growth in Asia has actually been pretty robust. It's been helped by exports. And so while previously one would have thought that central banks are going to respond to sort of higher inflation because of energy prices and also because of currency weakness, it is not necessarily going to be the case right now. So far, it has been the central banks of Indonesia and Philippines, which have actually had to respond with rate hikes to what we call as these supply shocks. But we think the central bank's reaction function is going to be more anchored around the growth outcomes, i.e., the more robust the growth outcomes, the more likelihood is a central bank rate hike coming. And I think this brings about very different implications into how we think about the implications of these rate hikes. From an economist standpoint, we tend to sort of think these rate hikes as being counter-cyclical in nature. And so therefore, central banks are going to lean in against stronger growth outcomes and potentially inflationary pressures generated from the demand side rather than the supply side. What are some of the central banks that we think will be responding more to these growth outcomes? We highlight the central banks in Korea, in India, in Taiwan, and in Malaysia. As you would imagine, growth outcomes in these economies have been actually relatively robust. And so as we get the incoming data that proves the point that growth is pretty strong, we think the central banks will be comfortable to either initiate or take up further tightening measures in order to lean in against these growth outcomes.
We'll talk more later about the growth outcomes and the factors contributing to that, but let's move on to inflation first. So oil prices, they've been remaining relatively muted, but then we're also seeing price pressures emerge with hot inflation prints from Australia and Singapore this week. Do you think markets are underestimating the potential inflation shock?
Yeah, from a framework perspective, this may actually not be the case. So typically for inflation, we tend to break it down into demand side factors and also supply side factors. And I think that the origins of this expansion or this economic cycle in Asia particularly is that it's very much exports and also capex driven. So in light of that, what we are seeing is that productivity dynamic is actually improving across Asia. And when that happens, That will tend to bring some inflationary pressures, but perhaps not as intense as one might expect it to be, because there's going to be the expansion of the supply side as well alongside that. The other thing to consider is that, you mentioned energy prices earlier on. The other thing to consider is the transmission of the energy prices. As we saw in the earlier rounds of the energy price increases, policymakers are cushioning the rise or the transmission from international fuel prices into domestic retail fuel prices through fiscal measures to some extent. And so we think that that may continue to be the case. And so that impact may be tapered by also some of the policy measures that we will expect to see. If you take a step back and think about the inflation outlook, yes, some of the inflation prints have been moving a bit higher, but currently we still have 7 out of the 12 economies that we cover that have inflation within the central bank's targets. From the outlook perspective, that number will probably reduce to about 6 by 4Q of 2026. But then that number will again rise back to 10 by 4Q of 2027. And so, in other words, what we are forecasting is that inflation is probably not as expected to be as serious a challenge as what some may make it out to be, because we are forecasting that the inflation will remain within the central bank's targets.
Another major factor shaping both the inflation and growth is the AI boom, which continues to gather pace. NVIDIA's latest earnings beat has reinforced its strength of that cycle. How much of Asia's economic growth is currently being driven by the AI build-out?
The most obvious transmission mechanism that we have to think about is via exports, and specifically tech exports in Asia. And if you look back in 2025, that was a very critical buffer for Asia's growth outcomes, because non-tech trade or non-tech exports was affected by tariffs in the first 3 quarters of 2025. But I think when we look at today, what has been happening is that yes, tech exports have been pretty strong, but the non-tech exports have also been picking up. And I think that is a very critical part of the outlook that we would like to highlight. For context, tech exports in the region is about 25% of the overall export baskets, but non-tech is the much bigger part at about 75%. And so the pickup in the non-tech part of the export basket is arguably more important in how we should think about the outlook, especially when we think about the spillover implications. The transmission mechanism, as we think about it, is that as exports growth tend to be relatively strong, that tends to bring about stronger capex, and stronger capex would then therefore lead to improving labor market conditions. And then the labor market conditions, as they improve, will then lead over to a stronger consumption growth. And what in effect that helps to do is to broaden out the recovery and then to put the growth outlook on a much better footing than just being driven by AI and tech.
You mentioned non-tech exports. Does that allude to also energy infrastructure?
Yeah, that's right. So if you take a step back, one of the main theses that we have for the Asia growth outlook is that there is actually an industrial and capex supercycle that is underway. That the perception of it may be that a lot of it is driven by AI and tech related, but we actually highlight that there are four key drivers to it. Number one is AI and AI related digital infrastructure. The second is on energy. The third is actually related to defense spending. And the fourth is that there's a broader industrial capex happening in the region. What are some of the reasons they're driving? I think AI does not need any further explanation. AI and related spending are still a top priority for CIOs around the world. And because Asia is a key supplier to the AI supply chain, and the companies that are resident in this part of the world will have to also collectively lift their capex to meet the rising demand. On the second factor on energy, economies are having to spend more on energy for powering AI, making the energy transition to renewables, and for energy security. And this would have actually moved out the policy agenda after the recent energy shock. The third thing is about defense spending. We've already seen budgeting increases in defense spending in the coming years across the region. And the fourth is that there's going to be an onshoring of industrial supply chains by Asia economies, which we think will also help to catalyze a broader capex and industrial cycle as the full effects work through the supply chain. What will happen is that there will be a positive reinforcement loop amongst all of these drivers, and then through the transmission mechanism as well, impart greater sort of impetus towards capex across the region. Now, what is happening on this front is that we expect that capex in the region will rise from about $11 trillion in 2025 to about $16 trillion in 2030. And the one important thing to highlight is that we are expecting that there's longevity to this capex cycle for a couple of reasons. One is that the factors that I alluded to, i.e., AI, energy, defense, and industrial capex, these are structural drivers and they are not just tied to cyclical issues. The second thing is that when we look at corporate debt to GDP levels in Asia ex China, we're actually kind of about the same level as we were about a decade ago. In other words, the corporate sector in Asia has not really levered up. And so, therefore, there is a lot of room and capacity to actually pick up that capex spending that we are expecting.
Still to come, we'll discuss Southeast Asia infrastructure build-out, revisit the latest tariff developments, and examine the economic prospects for Singapore and Japan. More on that with Derrick, Asia economist at Morgan Stanley.
Market Focus Weekly, now hosted by Howie Lim. A sharp weekly deep dive into what's moving markets in Singapore and across the region, with analysts and market insiders to break down the forces shaping the week ahead. New episodes every Friday, powered by the journalism of the Business Times. Find Market Focus Weekly wherever you get your podcasts.
Welcome back. Derrick, you mentioned the energy infrastructure build-out as one of the 4 key drivers. I'm actually quite interested to know, in terms of the progress that we're making on the ASEAN power grid, where are we now?
I would want to actually take a step back and return to sort of our overarching thesis on Asia, right? Which is that the capex supercycle is driven by the 4 factors of AI, energy, defense, and the broader industrial capex, right? As it comes to the energy infrastructure part of it, there is actually a much bigger component to that, in a sense that we are expecting that the energy capex in the region will grow by about 9% on a compound annual growth rate. And what it means is that it will rise from about $900 billion this year to about $1.3 trillion in 2030. Specifically, there are 4 factors that we would point out where energy spending will rise. First of all, there is actually a steady state power demand growth. Asian economies are still growing. Asia's power demand is still going to grow, and that will be one of the factors that will drive energy infrastructure across Asia. The second driver, as you can imagine, will be the powering of AI. As AI adoption picks up, data center capacity comes online, there will be a need for greater power. And so, therefore, we think that this will accelerate new dependable energy investments across fossil fuels, energy storage, and also grids infrastructure. The 2 other factors is related to energy transition and energy security. So most economies would be working to substitute the imported oil and gas with alternatives, and we have seen that definitely picking up across Asia. That will be the driver that will catalyze and sustain the overall energy capex in the region.
Let's move on to some of the other latest headlines this week. We're seeing tariffs pick up again between the US and Canada. How well positioned is Asia if we see another round of Trump tariffs targeting the region?
So to understand the potential implications, we probably have to go back to the data. And what we can see is that in 2025, as the tariffs were being implemented, there was a bifurcation in terms of the performance in trade. Tech, which was relatively unaffected by tariffs and also had the underpinnings of a structural growth driver, was actually relatively unperturbed during the tariff implementation for March of 2025. Then as we sort of move towards the 4th quarter of 2025, when trade deals began to fall in place for the region, we actually started to see that non-tech exports started to pick up quite meaningfully. So what does the data tell us and what can we infer from it? I think one is that we need to see if the tariff rates on Asia will pick up significantly from here as a risk factor. At this point in time, that is not in our base case. And so therefore, we are continuing with the forecast that the non-tech exports part of the equation will still continue to grow relatively well. The second part of it, as you can imagine, the tech exports part will be driven more by non-tariff related factors. So it will be driven more by what's the outlook for AI spending, not just in the US, but across the world. And as long as that holds up, that tech part of the equation will continue to hold up pretty well. Again, just to sort of return to where we were, this capex supercycle that we have been talking about is actually helping to also translate into a boom in trade and will continue to hold up relatively well as long as we don't get a significant increase in tariff rates on Asia.
let's move closer to home. So Singapore has recently raised its GDP growth forecast for the year, underscoring the economy's resilience. But we also saw manufacturing data this week falling to a 5-month low for July. What is your outlook for Singapore's economy?
I think the way that I would summarize the outlook for Singapore's economy is that we expect strong growth to continue and the base to broaden. And so what happened was that given the better than expected first half of 2026 economic performance, we had actually raised our 2026 GDP growth forecast to 5%. What this forecast implies is that Singapore would actually register a third consecutive year of growth that is around or exceeding the 5% mark. And so why do we expect the base to broaden? First of all, we expect the electronic cycle to play a very crucial role in supporting headline GDP growth. But at the same time, we're highlighting that the base of the economic expansion will progressively widen as we move through the coming quarters. First of all, the external backdrop for Singapore is very, very conducive. There is that capex supercycle that I keep alluding to, which is unfolding, and then that is helping to foster trade growth. And so that support, given that it extends beyond AI and extends into energy, defense, and industrial capex, chipping in as key drivers, that will mean that Singapore's high trade orientation makes it a direct beneficiary of this super cycle, allowing for the continuation of that robust growth that we have seen so far. The second thing that I want to draw your attention to is that we are already seeing signs and growing body of evidence that non-tech exports have been picking up across in Asia, and that also extends to Singapore. As exports start to broaden out, this will have the positive spillover effects to the non-tech sectors, manifesting itself into stronger gains in investment growth and also improving labor market conditions, all of which will actually form the basis of a broader base for economic expansion in the coming quarters ahead.
And moving on to another economy in Asia, Japan. So the yen has not responded significantly to recent efforts by Japan and the US to coordinate on currency policy. Where do you see the yen heading from here?
Our FX strategist has a neutral view on the Japanese yen at this point in time with a slightly bearish skew. And the explanation for that offered by the team is that there is actually a negative US dollar risk premium that has been triggered by the buyback announcements. And that could in turn weigh on the USD Japan yen via the broad USD weakness. But on the flip side, the reason why our team is neutral on the Japanese yen at this point in time is because higher energy prices and relatively elevated US terminal rate pricing will continue to weigh on the Japanese yen at this point in time.
What's your outlook for the Japanese economy amidst the backdrop of persistent inflation, record levels of debt servicing costs, and expansionary fiscal policy?
I think you have to take a step back, look at the bigger picture. The construct that we have had on Japan for some time is that Japan is on this reflation run. We think that Japan economy is actually going into a sustained shift towards a stronger equilibrium of moderate inflation and also relatively robust nominal GDP growth. And we expect that this will continue in the coming quarters for a couple of reasons. First of all, there is a stronger consumption recovery that is taking hold against a backdrop of the positive real wage growth. Yes, a part of this stronger consumption recovery in the very short term is because of rising inflation expectations where consumers are front loading purchases. But the underlying drivers of consumption growth are still intact. And so therefore that will help to sort of drive the consumption recovery. The second factor is, as I've been talking about on this podcast for some time, is exports. And exports growth has also been strong in Japan. That has also started to kickstart a capex cycle. Japan loan growth has also been accelerating to a historical high for the data set, which starts from the early 2000s. The third factor is that this capex cycle will be supported by policymakers' plan for a multi-sector investment plan throughout the long term, targeting the 17 strategic sectors. So if you look at the drivers to growth, whether is it coming from the external side, i.e. through exports, and from the domestic side, i.e. through consumption and investments, we can see very strong reasons as to why the economic outlook will be relatively constructive. And I think that if you consider that backdrop together with a favorable domestic policy setup which supports reflation, I think the outlook for Japan remains relatively positive.
Thank you for joining us today, Derrick.
Thanks a lot, Nicole, for having me. It's a pleasure to be here.
Derrick, Asia Economist at Morgan Stanley. If you have questions or feedback, drop us a note at btpodcasts@sph.com.sg. And for the latest, tune in to Lens On Daily, Monday morning at 10 a.m. This has been Market Focus Weekly by the Business Times. Till next Friday.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.